Hey everyone, it's Imran from Options Insight with your last macro options spotlight of 2022. Before we jump in, please like, subscribe, comment to this video. So that really helps us with the algorithm and gets this content in front of more people. Okay, so stocks staging a decent bounce, up 1.5%, pretty much across the board. China a bit better. Obviously, they continue to relax their COVID measures. Markets taking that well. But S&P up 1.5%, and that was after the Bank of Japan move, which kind of initially spooked markets, was pretty well digested. And then as the bond market stabilized, stocks took that as good news, nothing to be too fearful of, and markets managed to rally. Now, we had flagged that the VIX expiry, if it was a downprint, which we thought it may be because the fact that people kind of need to offload volatility into this Christmas period and they want to keep their theta bills down. So that did print down pretty heavy. The VIX printed, I think it was around 21.5, 22 the day before, and it ended up printing on the open 20.25. So it got absolutely hammered. And that kind of helped support the market because generally when there's VIX selling going on, that translates into S&P buying. And so that may well have inflated the market a little bit yesterday. And we are starting to see it kind of pull back a touch. As I expected. I mean, if it was VIX related, we have got other factors that are now dragging the market back down, like that big strike that we mentioned, 38.35, and that thing will experience what we call charm through the passage of time between now and when it expires in 8 days. And some of those days are not even trading days, right? So the passage of time is going to make dealers need to sell delta if we are sitting above the strike. And right now we're sitting above the strike, which means that call option that dealers have is going to charm longer delta, which is going to make dealers sell delta, which is going to make the market drift back down and kind of have that gravity towards the strike. So that's what we anticipate happening. Metals failing to really push on. They had that strong rally. Obviously, silver was up hard, 5% a couple of days ago, and now that's pulling back smalls. Whereas energy having a good day, oil up nearly 3%, natural gas slightly higher, and uranium having a good day as well. So that's kind of, we're again seeing that whenever metals aren't so strong, energy does better. And then when energy is weak, we often see a rally in metals. So I think a dispersion trade, for those of you who know who that is, would probably work quite well in commodities. Okay, looking at volatility, smashed lower, as we said, kind of people really wanting to offload theta ahead of the holidays. We do think that 30th of December strike is playing its part, though, in that offer in volatility, as people kind of get stuck with that vol that's paying decay and they need to sell whatever they can across the curve. And then commodities vols also softer, particularly in the gold miners, which is down over 2 vol points. US stocks flipping to deeper negative carry. Obviously, as we got a pretty healthy up move, over a standard deviation up move of 1.5%. Whilst vols are getting absolutely obliterated. So then that's going to show up as negative carry because the realized vol is holding up pretty well relative to the current implied vol. Europe also putting in some more consistent moves. Remember, it went pretty sleepy for a good month or two in Europe, and now all of a sudden it's moving again. And that's why we see negative carry in Europe of negative 50%, which is about as high as we've seen that in terms of, we say high, low because it's a negative number, but high in terms of realized vol relative to implied vol. Asia is still in positive carry though, so that's not really budged too much. And then in commodities, the only positive carry that we're seeing is in oil and in uranium at around 20% apiece. Skew continues to fall as the downside fear faded after that knee jerk on B over J. And we do see skew in single digit percentiles pretty much across all the major indices. So that's interesting, skew getting annihilated into year end there. If you are looking for hedges, and I don't think many people are because people are just underweight, but if you were looking for hedges against any longs, now's not a bad time to start scooping some skew up. And March 23 is probably the bucket I would look at as opposed to 1 month because you want a bit more time for things to actually materialize. And if the market does go down, you want to hold something that actually has some vega on it if you think vol's going to go up. Whereas if you go too short dated, it's going to be decaying too fast for you, basically. And then in commodities, natural gas skew, as we already flagged yesterday, continuing to move towards the puts. And it's only minus 5 vols now, right? Which is incredibly tight relative to where it was. So really maybe some fear coming in there that the upside isn't going to be as dramatic in natural gas. And now if we break to the downside, that big $5 level in US natural gas, then that could open up a lot more downside basically. And you know, whilst we did open up 4% in natural gas yesterday, by the end of the day, it was only up 1.5%. So that rally getting faded pretty quickly. So not the best price action in natural gas. Okay, looking at the other assets. So, you know, there's lots of stuff to think about for next year, but a couple of things that stood out to me at the minute. One of the biggest themes, obviously, the direction of US yields. So bonds have recovered strongly from recent lows, like a couple of months ago. TLT got down to 92 and then it traded all the way up to 110. It's kind of sitting back at the middle now, around 103. And obviously the US recession looking likely like a done deal, that it is going to happen. It's just a case of when and how bad it gets. And the yield curve just kept inverting, right? Going to cycle extremes. So the Fed is signaling that they're not going to be quick to pivot at the first sign of trouble. And that's kept a bit of a bid under treasuries. The stock to bond correlation has been dropping. And that 4% risk-free rate that you can get in treasuries is starting to look more enticing relative to potentially lofty equity valuations still, basically looking at what earnings are likely to be. The question this week, though, has been, does the Bank of Japan's policy move throw a spanner in the works and trigger another march higher in global yields? Okay, that's the real concern. And also some people thinking, you know, bond yields could go a hell of a lot higher, right? And remember, one of the reasons why US yields went way further than we were expecting was because European inflation was so rampant and European yields moved so much, and that kind of dragged US yields with them. So the question is, are we going to continue to see Japanese and European yields march higher? And is that going to drag US yields high? Because that's definitely a risk. Now, so far, the spillover seems relatively contained. And, you know, it's the dollar yen really that's had the massive move. Bonds did move, but they're starting to stabilize. Now, Andreas Steno Larsen, who presents Real Vision Daily Briefing, he pointed out an interesting chart you can see here on the left. And it's basically Japanese holdings of treasuries versus the dollar, right? So he's inverted the dollar position. So that's the blue line. Obviously, the dollar, you saw the dollar massively go higher in that move there. Oops, let me just draw that. So the dollar had a big move here, and you saw treasury holdings drop in terms of Japanese treasury holdings. So then if we do see a bounce, he's saying we may well actually see more buyers of treasuries come in from Japan. Okay, now that seems a bit counterintuitive, but that's kind of the correlation that has been seen. And he's saying that maybe this is actually more supportive for treasuries than we think it is at the surface. So just an interesting thing to highlight there. And if that is true, then maybe we don't need to be so scared that US yields are going to march that much higher, even if Japan are kind of changing their policy. And it all really depends on the dollar, right? If the dollar yen does continue to move all the way back down, then that may actually be supportive for treasuries. Another big theme next year is going to be sector leadership. Obviously, this year we've seen commodities as a star performer, energy sector, metals and mining, far outperforming all the other sectors. And then that rotation out of technology that we've seen into value and old economy. So obviously the Dow Jones massively outperforming the S&P, which again is outperforming the NASDAQ, right? So are we going to continue to see that theme of that sort of rolling bear market where, you know, everyone moves out away from tech and away from that high beta into that lower beta stuff? Does that continue for a while? The last general of the tech sector is Apple. You can see here massively outperforming versus what the rest of the FANGs have done. So really how the NASDAQ fares early next year is going to be largely determined by what Apple does. Does Apple go the way of Meta and company and catch up and go back to the downside here? That's massively going to drag the NASDAQ with it. Or does Apple continue to shrug off, hold on to these support levels that it hasn't broken yet and march higher as it kind of has been known to do? So those are the things we need to think about and are going to be major things to be watching out next year. Okay, looking on, if we look at gold, so gold's obviously had a little pop on the Bank of Japan, and it's got above this key level, which it hasn't really broken since the summer. So if we go back to August, this 1810 level on gold is pretty key. And it has managed to finally close. It did intraday breach it, but then it closed back below it. Now it's finally closed above it. So the question is, does it march to this next big level up at 1880-ish? Or is that a false break and it rejects and it comes back down? Either way, I suspect gold doesn't just sit here, basically. Okay. And whilst it might be quiet between here and year end, just because people have shut up shop, we could well see a load of inflows get triggered back into GLD, given that this move has happened and this price action does look pretty stable, right? This upward sloping trend that's forming here. It might entice a few people back into that market. And the fact that the dollar is showing signs of actually really having topped, that might encourage people back into gold as well. So looking out for that. We do think gold has the potential to either get rejected or to break higher, but we suspect it doesn't just sit here. Silver's obviously been flying to the upside, to some extent leading this move in gold. And again, that might attract people into precious metals in general, and gold may then follow what silver has been doing. So that's something we're looking at. Looking at the Vol dashboard, in terms of opportunities, having a look at our fixed strike Vol monitor that we've kind of recently included in our service. So if you look at the S&P and you compare it to where it was from Friday's close, so Friday OPEX just gone after the close, now where are vols compared to that closing print? And you can see vols have been absolutely battered again, right? So even though spot kind of has, the S&P spot went all the way down to 37.80 on that Bank of Japan noise, and it's recovered all the way back up 100 points from there. So it's kind of finished up 70 basis points since the close on Friday. It's a slightly higher market. And what have vols done? Vols have got annihilated. Okay, so you've seen January down anywhere between a vol and a vol and a half. Same for February, particularly on the downside. So you can see there's this skew to the downside, which is getting particularly hit. The whole curve has kind of shifted in terms of at the money surface. So the idea is that this price action in implied volatility, in the face of a market that's been realizing and moving around quite nicely and giving you gamma scalping opportunity, vols are still getting crushed. Okay. So if the street was short a load of vol, okay, then vols would not be getting crushed quite as hard as they are. Okay. And the fact that the market is realizing quite nicely and the fact that vols are still getting hammered suggests that dealers are long vol and they're lightening up their theta bills going into Christmas. Okay. Even though the gamma is realizing quite well and they probably managed to make some money back in the movement this week, the fact that their theta bill is probably rising because of all these 30th of December options that they're long, and if that stays close to the money, that theta bill is going to go up because that gamma is going to go up as we go close to expiry. That's what happens as you get close to expiry on a local strike, the gamma explodes. And against that gamma exploding, their theta bill is going to explode. So what are they going to do? They're going to smash out anything they can get their hands on in terms of short-dated volatility to lighten up that theta bill. So that's what we've been seeing. And that gives me stronger conviction that the market is more pinned here because dealers are choking on vol, choking on gamma, and that's going to make it hard for the market to move materially higher between now and year end. Whether it moves lower or not, who knows? If we break below 37.50, I think it could move materially lower in a similar sort of move to what we maybe saw in Christmas 2018, but we're running out of time for that to happen, right? I mean, literally, we don't have many days left now till Christmas. So hopefully everything will be all right. We won't get some ridiculous meltdown, but base case has to probably be the market's just going to do not a lot and kind of stay around here. And that's why yesterday we did suggest that trade for those who are looking to pick up some carry, maybe selling some short-dated S&P call spreads made a bit of sense. All right, that's it. It went slightly long today, but it's the last one of the year, so I thought, why not? It's been a pleasure. I hope you guys have a great Christmas and New Year, and I'll look forward to giving you these sort of updates in 2023. Thanks a lot.